All right, let's get started with the latest numbers from the MLS, if my computer is cooperating. So this is just the latest data. This is for our metro area here specifically. Those are the four counties, so the WOW
The music,
counties.
right? Mm-hmm.
And Alexandra, can you? Yes, thank you. So these are the four counties, the Milwaukee metro area, including Milwaukee County, of course, and then you have Washington, Ozaukee, and Waukesha County. Those are what these numbers are from, and those are the latest numbers. They're from MLS. Inventory is the first one here. We have only 1,463 single-family homes on the market. It's 22% more than last year, but that's really the magic of the small numbers. This is an extremely tight inventory, and you can see how little that inventory is if you compare it with the historic numbers below. You have your 2019, for example, that was before COVID when we still had a normal market. And if you want to go back 10 years to 2015, you can see that we had over 5,000 houses on the market. So that is a huge difference. In terms of sold units, it's a very narrow market, not for the lack of demand, but quite frankly, a lot of the inventory that's out there is just total junk. So with that, we only had 787 transactions closed. Velocity is picking up as it always does in the spring market. So we're at 7 days on market. In reality, that means that a lot of listings are closing on the first weekend. And the median sold price is up again 8.63%. So not quite double digit this month, but the median price is now $365,000 for the metro area. And if you look down the historic numbers, it's basically just a little bit more than double from where we were 10 years ago. So those are the latest numbers. Some of the market trends that we've seen. The February price increase was an outlier. So if you happen to follow me on YouTube, you may remember that in February I was telling you that Milwaukee was the number one most competitive market in the US. Redfin made a press release to that effect. And so we were more competitive than the East Coast and the West Coast and Florida. And we had in February seen a 20% price increase year over year. So February was really an outlier there because February last year was exceptionally weak. So when you compare February to February, you get a large gap. But it's better to look over a little bigger time frames. So if you compare the first quarter, we are still looking at prices that are 11.1% higher than the first quarter last year. So if you look on a bigger data set, that tends to smooth out a little bit more these individual outliers. So very strong market appreciation, in fact, stronger than we had it before, even during the COVID years. Spring inventory finally arriving, very high market velocity. Everything from a residential buyer point of view that's worth buying at the moment is basically gone within 2 or 3 days. So we accept offers usually on Sunday. And from an investor point of view, I used to buy a lot of distressed properties. The problem is at the moment you can barely find anything that is distressed that gets you even a little bit of a discount because there's going to be some first-time home buyer who does not understand how much money and time and effort it will take to rehab a property, and they're willing to pay basically full price. And so you, as an investor, it's very difficult to get a discount for condition. 3 to 5 offers on a good listing are the norm. Competition drives prices. And here I've broken that down a little bit. There's more information on my YouTube channel if you want to dive deeper into that. But 62.5%, so almost two-thirds of all listings that have sold in Milwaukee this year have sold over list price. Over. Not even at list price. 14.4% were at list price and 23% were below list price. So there are still deals where you can negotiate, but basically two-thirds of all accepted offers, all closed deals, I should say, that we've seen were over list price. A big question that I got a week ago was after the implementation of the tariffs and the subsequent crash that we've seen on the stock market, which has recovered since, was how is the local real estate market impacted here in the Milwaukee area? And that's a bit of data that was not easy to get to because real estate is moving at a glacial pace, so it's very slow moving. It's not like the stock market, and you only get good numbers a month or 2 months, after the fact. So if you want to understand what is going on in real estate, like now or last week, you have to look for a very specific metric. And what I was able to pull here is accepted offers in the Milwaukee metro area per day. So on which day were these offers accepted? Because that shows you really instant feedback what's going on in the market. You see here the spikes that we have on every weekend. So Saturday, Sunday, those are in orange. That's our typical weekend cycle. Listings come on the market, and most of the offers get accepted on towards the end of the weekend. Sometimes the agents are not putting it in until Monday or Tuesday, so you see a little bit, going over there, and then uh, Tuesday is usually the lowest point in the week. So the question was specifically from our investor clients is how is the current situation with the economy, with tariffs, and with the stock market crashing? How is that impacting the real estate market? And normally, when we see something happening in the economic environment, when interest rates are shooting up suddenly, what we do see is that the market tends to freeze for a little while, at least for a couple of weeks, before everybody has digested the news and things start flowing again. The interesting thing is we haven't seen that in this case. So you can see here the tariffs were announced on April 2nd. Then the stock market had a rough time the rest of the week, and the Milwaukee real estate market really couldn't care less. If anything, we had more accepted offers that week than in any week before. So now you can speculate, why is that? Is money from Wall Street going into real estate? I would say that is probable, but that would be too quick. That usually takes time before people start, liquidating a stock portfolio and allocating it to different assets. That wouldn't go that quickly. I would say this is mostly because April is really when we are seeing more inventory now. So there was more stuff on the market. We have so many buyers out there right now, and they were not too phased by what's going on in the stock market and with tariffs. Any questions on this? If you do, you can always put them in the chat. Oh, I see Kurt Bauer said, viel besser um diese Zeit. Yeah, indeed, right? Um, all right. Back on this screen. So here's a quick overview about what that looks like, how many offers are selling over under list price. This is the 1/3 that is selling at or below list price. The other 2/3 are selling over. We have analyzed a little over 2,000 deals for this. So you can see here the lion's share, or the biggest chunk here, is up to 5% over list price. That is very common. That's typically when we see between 3 and 5 offers. Um, it's I'm talking percentages here because we are beyond that point where you're saying, oh, let's offer $2,000 or 3,000 more than list price. You really have to, that was 3, 4 years ago. We're really in a space where you have to say, okay, 3% over, 5% over, etc. Then we have the really competitive segment that's relatively small, 15%, that went between 5 and 10% over list price. So on a $500,000 listing, that's 50 grand over list price. And then we have some deals that are just nuts. 9.8% went more than 10% over list price. I was working on a deal in Whitefish Bay that went $205,000 over list. Those deals exist. Are they the norm? No, they're not. So you can still say that 2/3 of everything is happening between -5% and +5%. That makes up 2/3 of the deals, and then 1/3 is going beyond that. Hope that helps. What this statistic is not showing you is that not every listing is selling. So that's important to know for sellers, especially investors tend to make that mistake. They're like, yeah, the market is so hot. I can ask whatever I want, and some idiot will give me a ton of money for my house. That is not the case, even as hot as the market is. we had in the Milwaukee area so far 724 listings expire. They did not sell. So there was no buyer that wanted to make an offer on them, and that's usually price or condition, oftentimes a combination of both. But very often what I see is that people just have completely irrational ideas of what their house should be selling for. And the market is rather brutal with that. So if you're not priced competitively, the market will just ignore you. Buyers are, still very smart in that aspect. The only thing that they don't seem to understand is how much rehab is. They seem to think they can do it in a couple of weekends and with a few buckets of paint. And that's, as everybody who's in the game knows from experience, that's not the case.
Hey,
All right,
Marcus.
here's a big
Okay.
picture overview if you're not familiar with my
Hey,
market update on
Marcus.
TV.
Before we move on to the next slide, I have someone who asked about the last slide. Is
Yeah,
this retail buyer or investor data?
you can't tell who they are. I can break it out by cash buyer and financed, but that doesn't really say anything either. We had about 16% cash offers in all that. Um, I would say by and large, this is the retail market. And investors are, as an investor, we're basically competing with retail buyers. So we're all working in the 1 to 4 unit segment. So in the residential space, we're all operating in the same market. That's why I said before, as an investor, I'm competing with first-time home buyers. I want to buy a single family that I can burr, and they're thinking, oh, that's great. My uncle is a electrician. He can help me fix up that house. Take me a couple weekends next summer, and then we'll fix up the house. And, obviously that's not realistic. But no, we don't have hard data on how many of these 2,000 some deals were purchased by investors. We don't know. So this one here is a little bit of a big picture. So in the red line here is the national real estate market median sales price over the last, what is that, 10, 12 years. And the green line in comparison is the Milwaukee metro area. So there's a few things that stand out here. First of all, the Milwaukee prices are still significantly lower than the national average. And I've been saying this for a year. If you travel a little bit in the US, Milwaukee is not a below average city. There is no reason that our real estate should be sold for below average prices. And I think we're seeing that gap closing now. So this does not even include this is not explicitly any of the expensive markets. So if you pull some East Coast or West Coast markets into the chart, it will completely flatten these two curves and put them down at the very bottom because they're so absurdly higher than we are here. So the red line is just the average, national average. And Milwaukee, yes. Oh, I heard somebody.
I think that might have been an accident. I'm going to mute him.
Okay, super. So the other thing that you see here is the seasonality. We have a very strong seasonality in Milwaukee with our winters and summers. So these are always spring, May, June, July peaks here, and then obviously December and January we see the lowest prices. Are market values really dropping that much? No, of course not, because you have the data is biased here because most of the nice homes go on the market in spring and summer, and more of the junkier homes are going to be sold in the winter. So that amplifies that curve. But I would say there is still a 3 to 5% price advantage buying in the second half of the year and into fall. I think over 80% of our portfolio I have bought in September, October, and November because that's when you generally get better prices. Competition is not as stiff. The spring market is really the worst for us investors. The other thing that you can see here is that the national market went really crazy here during the COVID years and is now in a little bit more of more sideways trajectory. So we still see national home prices go up, but they are not going up as fast anymore. It's just a healthier pace of home price appreciation. So I expect this to continue this year. And when you look at the Milwaukee trend, we're in a much steeper trajectory. And so that gap between national average and Milwaukee seems to be narrowing. So we'll see where we are in 10 years from now, but I would not be surprised if we get caught up to the national average. I think that was it. If you want to see a little bit more, there's like 20 more slides, then just check out the April market update. You can find it on YouTube. And with that, let's talk about the topic of today, which is how to make $1 million in residential real estate. So what I'm trying to do here is I'm trying to get you thinking in the right direction. Because what I find, especially with a lot of new investors, that they're really looking at this the wrong way or in a very one-sided way. And even seasoned investors sometimes get caught in that hamster wheel and can't seem to break out. So for some of you, this may be very repetitive, but you can still go and say, well, am I really following these principles? And is there something that I could be doing better than what I'm doing now? Because in reality, investing in real estate is not rocket science. It is relatively simple, conceptually speaking, but simple and easy are not the same thing. So it is definitely not easy, but the concept is relatively simple. And so I want to get you back to some first principle thinking. Maybe some of you follow Elon Musk a little bit, so you're from on the engineering side, I mean, and politically maybe too. But on engineering, he's talking a lot about first principle thinking, and so this is the same thing here. If you ask ChatGPT, how do real estate investors make money? This is the answer that you're going to get. So there's 4 ways that we make money off real estate. The first one is cash flow. That's basically rental income minus expenses and financing. The second one is appreciation. That's the property value increase over time. There's natural appreciation and there's forced appreciation. So when you improve a property, you're forcing the value of the property up. You don't need to wait for the market to do that. Then you're deleveraging, so that's your loan pay down. You are typically paying off a mortgage over 25 or 30 years, or your tenant is doing that for you, I should say. And eventually you own the property free and clear. So there you're building equity. And then you also have the tax benefits. You're depreciating the assets. Maybe if you're a real estate professional, you can shelter some of your income. You can deduct and you can defer. So eventually the tax doesn't go away, but we can almost indefinitely kick that tax can down the road. So when you want to make $1 million, you make it out of these 4 buckets here. And when I show you this pie chart, does anybody have an educated guess for which one the biggest segment is here out of these 4 categories? Appreciation got 3 votes, and that would be correct. Loan pay down is also a pretty good one. So I'll leave this up here for a second because that's worth letting it sink in here. And most people would, when they decide on an investment property, what they have on their mind is that green segment here that's cash flow. Everybody is like, does it cash flow? How much does it cash flow? And a question that I get a million times on Bigger Pockets, of course, is I want to quit my W-2 job. I want to invest in real estate. And I want to quit my job and want to replace my W-2 income with cash flow from real estate. And ideally, I want to do that in the next 2 years. And, of course, that is not very realistic. Not, Has somebody done it in the history of America? Maybe, but it's not easy to do. But appreciation is the biggest segment. That's more than half. Loan pay down is also a big chunk, and the tax benefits will vary a little bit on your personal situation and how much you can actually shelter from taxes. But this is basically how we're trying to piece together a million. And what you can very easily do, and what I would recommend doing, is get on one of the calculators. You can use the ones that are on bigger pockets. So if you look on the top menu on the website, there are rental calculators, and you can just put a fictitious investment in there. And I would suggest that you basically put in for property value $1 million just for easy numbers. And let's call rent $10,000. So that's classic 1% rule. So that could be a little bit more, could be a little bit less. Let's say that's a four family in a nice area in, I don't know, Sherwood, with large units, gets you $2,500 each unit. So that would get you your $10,000 in rent. Rent increase, you can just go with conservative 3%. That's what I've done here. But as we've seen over the last years, rents have increased a lot faster. What is the 1% rule again? That is basically rent to property value. So the idea is that a $150,000 property or rental unit should rent for $1,500 a month. That would be 1% of the purchase price. So that's a very quick way of ballparking a rental property. If you're buying a duplex in Wauwatosa for $400,000 and it rents out for $2,000 a unit because it's large and nice, then you can basically say that is, 4,000 a month. So that's just about 1%. And 1% deals used to be very common, 5 to 7 years ago in Milwaukee. There used to be, you used to be able to buy 2% deals after 2008, but that's not happening anymore. Generally, what you find is that the rougher the condition of the properties and the rougher the neighborhood, the more you are able to meet that 1% criteria. So you can you can be happy about that, but be sure you're paying the price in another way, because you may not be collecting the rent always. They, may damage the property. You may have some other issues that come with rougher properties. So usually there's to the upside, there is also a downside. So rent increase, I'm just going here with the 3% assumption here. We have seen significantly more than 3% over the last years. Interest rate, 6.5%. Appreciation, 4.8. If you Google real estate appreciation over the last 60 years, I think Google will tell you 6.2%. But you can go with anything between 3, 5, 8, whatever you feel comfortable with. I used here 4.8, which is on the conservative side. Property management, 8%. Even if you do it yourself, you should budget for that because, you're putting work in, you should get paid for that. Then we had some monthly expenses, 5% for maintenance, 5% for CapEx. That is a wide range depending on in what condition the property is, and 5% on vacancies. And when you run those numbers on a bigger pockets calculator, then you end up with this here. So this is basically a financial model that gives you the theory. And I really would encourage you to do that and play around with the numbers, because it will give you an intuitive understanding, not just seeing the numbers and doing the math, but when you start changing the numbers and then you calculate it again and you look at the outcome, you're like, wow, that makes a huge impact if the appreciation is 2% or 4%, or the rent increase every year. So you gain an intuitive understanding for what really matters. So the assumptions that we had here, property value, $1 million. So that could be a four family or, two duplexes, whatever, or four duplexes. You need about $250,000, 25% down on small multifamilies. Somebody will ask me, well, can't I put 20% down? If it's single families, yep, 20%. If it has more than one unit, then it's usually 25% down. Unless you're house hacking a duplex, then Fannie Mae came back with the 5% owner-occupied loan. So that's a possibility to do it with less down. But for our math here, we're just using 25% down, which is 250,000. That leaves a loan balance from 750, cash flow 13,000, mortgage payment 4,000, profit if sold. Yeah, basically the cash flow in year one. So let's see what happens in year five. So in year five, with those assumptions here that I took before, in year five, we have a property value of now 1.264 million. So the property went up in value a little bit over the first 5 years. The equity has changed obviously dramatically because now you've gained the upside here. You've paid your loan down a little bit here, so that number has come down. Cash flow has increased. The property is also stabilized. Typically, when you hold a property for 5 years, you're also doing some upgrades to the unit. So you could increase rents more than 3%, but that's not even considered here. Mortgage payment is the same. Profit if sold, 420,000. So that gives you an annualized return of 21.78%. And if you map this out over 10 years, then here you get to your $1 million mark. So that's really the high level principal answer on how do you get to 1 million. Yeah, it takes a little time. It takes 10 years. Can it be done in 7 or 8? Absolutely. You can do it in 5 if you really look to it. But that is a very realistic time frame. That is not there are no aggressive assumptions in here, neither on the appreciation nor on rent increase. All of this is very, very conservative. When you play with the numbers and you adjust them up just a little bit, you get quite different results here. And then you can map it out over 20 years, and then you're already hitting almost the $3 million mark down here. What you also see is that the annualized return is going down. So we go from 21 to 17 to 13%. And the reason for that is that your return on equity is shrinking. So you're building more and more equity in your real estate, but your return on equity is typically a lot smaller than your return on cash, your cash on cash return. So that is getting smaller, smaller. And that's why the more your investment is maturing, the more you're burning through those tax write-offs, and the more equity you have, then your your total return is going down. It's also interesting. I used to be in the corporate world, and I was working for 17 years for a large corporation, and we eventually went public. We had an IPO. And the interesting thing is what really changed in the time period, that as long as the company was privately owned, we never wanted to take on debt. Everything was basically as much either short-term financed or cash financed. So we're talking construction machinery here. They didn't want to take on long-term debt. And as soon as we went public and we had shareholders, there was an overwhelming demand from the shareholders to bring in outside financing, and bring our equity down to less than 50%. Because the shareholders are looking at this and they're saying, what's the return on equity? If that's not good, then you bring outside capital in, you bring your financing to at least 50%, 60, 70% leverage. So you bring that percentage up again. So it's interesting just to play with these numbers so you get an intuitive understanding for how that works together. It helps you judge investment situations on a more from a gut level than having to run numbers every time. And this is what it looks like when you are letting it run for the whole 30 years. So from our $1 million property portfolio, the 4-family in Sherwood or whatever you want to call it, with the $250,000 down, in 30 years, this is what you get up. What do you get out? And that does not include trading into bigger properties. That does not include acquiring other properties. This is simply letting that one piece of real estate sit for a long enough time period and letting it letting it play out. So the principle that you start to realize here is the real estate magic is really happening when you multiply a portfolio size with enough time. So you can, in that formula, you can increase one or the other, preferably both. So you want to increase your portfolio size early on, and then you also want to run that portfolio for as many years as possible, because you're multiplying those two values that really helps you with the overall result. So there's no further real estate acquisitions. This is really a straight line, still the same property that we bought here. And then you're looking at total profit if sold of 5.9 million, almost $6 million. 30 years, of course. So the dollar also devaluates over the time frame. So that's a little bit of a caveat that we don't want to forget here. But basically, out of $250,000, you make 6 million over 30 years. The other thing that is this telling you is that I think I made a mistake in my career. I waited way too long to do a cost segregation study because I wanted to keep it simple and straightforward. And I should have done a cost segregation sooner because that would have allowed me to write off real estate more aggressively. That would have given me more capital from back here and moved it back to the front of my personal journey. And every, $10,000, $100,000 that you can put to the beginning of the journey and give it more time in the market invested multiplies that much more. So when you do strategies like a cost segregation that allows you to pull more of the cash, pay less in taxes, pull more of the cash out, buy more real estate, buy it faster, grow your portfolio wider, and then let that wider portfolio sit there for a longer period of time. That's the old conundrum where people always asking me, well, when should I start paying off properties? Should I buy more real estate or should I pay it off? That is the judgment call that you're making here. But play with these numbers, you'll get an intuitive feel for what is right for you, for your goals, and for your personal situation. So here's a little illustration on how this basically works. The $1 million four family in Sherwood, hypothetically, that is basically your flywheel. And if you're not that familiar with flywheels, the idea is that you have a motor that's spinning up a large mass, and once that mass is rotating, it will rotate basically by itself. You don't have to. It takes a lot of strength to get it spinning. It's like taking a train and start pushing it down the rail. But once the train is going with 60 miles an hour, it has an incredible force. And that is the same thing with the flywheel. So if you're in the process of thinking about how you're building your real estate flywheel, then you think about how big do you want it to be. The numbers that I gave you here is basically a $1 million flywheel. That's a $1 million worth of real estate that you bought with $250,000 down. And once this thing is up and running and it's spinning, then it starts throwing off money. And then it's just basically letting it sit there for 30 years and letting it do its thing. So the flywheel, I think, is a good visual to think about putting energy in to get it spinning, to get your portfolio going. It's a lot of hard work in the beginning, but once you have it running, then of course, then it works for you. And what's really working for you is compound interest. And I have here a very famous quote from Albert Einstein here. I think you all have heard it. And it never ceases to amaze me when you take a compounding interest calculator, if you're investing in the stock market and you play around with, I don't know, what happens with $10,000 that you put in an S&P 500 and you let that run for 20 years, 30 years, 50 years. If I tell you the numbers that you get out of $10,000 over these time frames, they are so large that you would not believe me. So I encourage you, find a compounding interest calculator and play around with those numbers. It is really staggering. So how can you do it, practically speaking? A very easy example for our market is duplexes. We have 66,000 duplexes in the Milwaukee area. These numbers are a little bit on the low side now. I would say you can buy a decent duplex now for 350,000. But for example here, let's call it 250 times 4, that's a million, 25% down. So what if you don't have $250,000? Well, maybe you have the 60 grand that you need to buy the first one. And if you can move in and you can house hack it, then you can buy it actually with 5% down. So that brings your down payment down to only 12,500. And then, buy another one next year, buy another one next year, buy another one next year. Does it take money to make money in real estate? Yes. 10 years ago, it was different. It's frustrating for people, for young people especially, who get started today. They read a lot of the books that have been written 10 years ago, and they're basically looking for, how can I replace my W-2 job with real estate, but I have no money and no credit? And my answer is usually to them, that is incredibly hard. First of all, you have to fix your credit, because if you can't even manage your own finances and pay your bills on time, then getting into real estate will only amplify your poor habits, and it will result in disaster. So fix your credit first, fix your own financial habits first, fix your financial literacy first before you personally are fit to go into real estate. And then the second thing is, find a way to make extra money. If you are hungry enough and you really want to do this, then I don't know, build an online business, flip couches, take a second job. You can find $12,500 in a year with the side hustle for sure, and get into a duplex. So that's why I said in the beginning, is it difficult? No, the concept is actually very simple, but that does not mean it's easy. It is hard to do this. But when you look at the other side, is it worth doing it? If you're looking at how this changes 20 years, 30 years later, your retirement, for example, I would make the case that yeah, absolutely, it's worth it. You'll have to fight for it, but it's totally worth it. So if you want to read a little bit more, I would say here are two books that I think are worth reading, especially if you're new to the industry or to the business. Rental Property Investing from Brandon Turner is a book that I really love recommending, because it is not a philosophy book. It is literally nuts and bolts. Everything from how to pick the type of property that you want, all the way to how to buy it, how to work with contractors, what to look for in the lease, how to work with lenders. All these things are covered in this book in a very step-by-step, nuts and bolts type of way. So you don't need to pay somebody, I don't know, $20,000 for some seminar. Spend $15 on this book on Amazon. Brandon Turner has it summarized here really nicely. There's a second part of it that he wrote with his wife Heather, that dives specifically then into managing. So it's called Managing Rental Properties. That's a good follow-up read. And then a little bit more on the money philosophy, wealth side, David Green's Pillars of Wealth. That is also a really good book to read if you want to look more of on a general financial picture.